What level of expertise does it take to ruin the world's largest economy in just 20 days? The United States stock market has always been a delicate balancing act, where confidence drives investment and panic can erase trillions overnight. But what happened in the last 20 days is unlike anything seen before. One decision, Trump's tariff on Canadian steel and aluminum, was enough to send shockwaves through Wall Street, triggering a full-blown financial meltdown. At first, investors were skeptical. The market had weathered trade wars before, but as details emerged, it became clear that this wasn't just another round of tit-for-tat tariffs. This was an all-out economic attack on key U.S. trading partners. The reaction from nations like Canada and China has made the U.S. suffer more than the U.S. ever expected. But what went wrong in 20 days? Let's find out. The United States stock market has always been a fragile ecosystem, held together by confidence, trust, and the assumption that economic policies will not blindside investors. In a matter of weeks, that confidence evaporated, replaced by panic selling and deep uncertainty. At the heart of this collapse was a single decision: Trump's sudden and aggressive move to impose tariffs on Canadian steel and aluminum. What seemed like another political move quickly escalated into something far more dangerous: a direct assault on the foundation of U.S. manufacturing and investment stability. In the immediate aftermath, the market did what it always does when faced with unpredictable shocks. It collapsed. The Dow Jones plunged by 400 points, wiping out billions in market value in a single day. The Nasdaq, often a beacon of optimism for high-growth companies, had its worst performance in nearly 3 years. Investors who had been bullish just weeks earlier were now bracing for a financial storm. It was a textbook case of what happens when uncertainty overtakes logic. The economic reality behind the panic was even more alarming. Canada has been one of the most stable and crucial trade partners for the U.S., supplying essential raw materials that keep American factories running. U.S. automakers, construction companies, and aerospace giants depend on Canadian steel and aluminum to manufacture everything from skyscrapers to military aircraft. By imposing a tariff that doubled the cost of those materials overnight, Trump forced American businesses into a crisis. Margins that had been comfortably predictable were now squeezed, and costs that had been stable for years suddenly skyrocketed. Companies had no choice but to adjust their earnings forecasts, slashing profit expectations and warning of severe disruptions. That sent investors scrambling. Fear spreads faster than facts. Almost immediately, Wall Street analysts began issuing stark warnings about the economic fallout. J.P. Morgan revised its second quarter GDP growth forecast downward, citing the sudden volatility in supply chains. Goldman Sachs, a firm known for its conservative predictions, increased its estimated recession probability from 15% to 20%, a jump that sent ripples across trading floors. Market watchers knew that a bad quarter was possible, but now they were openly speculating about whether the U.S. economy could be headed for something much worse. No sector felt the shock more than technology. The Nasdaq, which had been riding high for months, saw some of its biggest names take devastating hits. Tesla, long seen as one of the most resilient companies in the stock market, suffered a catastrophic 15.43% plunge. Investors panicked over what rising material costs could mean for its production capabilities. Nvidia, Apple, and Alphabet all lost more than 5% in a single day, wiping out hundreds of billions in shareholder value. Hedge funds, sensing a deepening crisis, dumped high-risk assets at an alarming rate, further fueling the downward spiral. This was not just a bad day on Wall Street, it was a complete psychological shift. The market, which had been celebrating record highs just weeks earlier, now operated in full-fledged panic mode. The optimism that had driven stocks to unprecedented levels had been replaced by deep-seated uncertainty. Traders, CEOs, and investors alike were no longer asking whether the tariffs were bad policy. They were asking whether this was the beginning of a financial catastrophe. And it all started with one reckless decision. But why such a reaction? Here's a reminder to please like and share the video and subscribe to our channel to watch more videos on Africa's geopolitics, economy, and changing landscape. Let's continue now. For businesses, stability is everything. It allows companies to make long-term investments, expand operations, and hire more workers without the fear that economic conditions will suddenly shift against them. But Trump's tariff war, particularly his aggressive targeting of Canada and China, has thrown this stability into complete disarray. When the 50% tariff on Canadian steel and aluminum was announced, followed by a sudden 25% tariff on all Mexican and Canadian imports, and then an increase in duties on Chinese goods to 20%, it became clear that this wasn't just a minor trade dispute. It was an all-out economic confrontation. Worse, Trump reversed himself within days, delaying some tariffs while keeping others in place. Businesses were left without any clear direction, a nightmare scenario for executives trying to plan. CEOs, factory owners, and investors now find themselves in a constant guessing game. One moment, a company believes its supply chains are secure, and the next, a new tariff sends costs soaring. Boardrooms across America are frozen in indecision. Some are canceling expansion plans. Others are cutting back on hiring. In industries where raw materials make up a large portion of costs, like automotive, construction, and aerospace, business leaders have no idea whether they'll be able to sustain production at competitive prices. One of the hardest-hit sectors is manufacturing. Factories that depend on steady material imports are suddenly paying higher costs for steel, aluminum, and electronic components. Some companies have already started shifting supply chains away from the US to avoid unpredictable pricing, effectively redirecting manufacturing jobs abroad, the exact opposite of what Trump's trade war was meant to accomplish. Even multinational corporations, which typically have contingency plans for economic uncertainty, are feeling the impact. In an earnings call, Delta Airlines shocked investors by slashing its profit outlook, citing a drop in corporate and consumer confidence. The company warned that recession fears, driven by chaotic tariff policies, are leading to lower travel demand. If consumers and businesses are scaling back travel, that means they are scaling back spending, and that's a major red flag for the economy. Wall Street analysts have coined a new term for this growing crisis: the uncertainty tax. This isn't an official tax, but rather an invisible penalty being placed on every business due to Trump's erratic policies. Companies that normally would be investing in expansion, hiring, and research are instead hoarding cash, afraid that the next tariff announcement could wipe out their margins overnight. David Kelly, chief global strategist at JP Morgan Asset Management, described it as a deer in headlights moment for business leaders. They know the risk of making the wrong move is high, so they are choosing to do nothing. This kind of economic paralysis can be just as damaging as a full-blown recession. If businesses don't invest, jobs don't get created, wages stagnate, and consumer spending slows. It's no longer just about tariffs, it's about trust. And right now, trust in US economic leadership is collapsing. Now the question is, how much money has the US lost in this market meltdown? In the blink of an eye, nearly $1.75 trillion in stock market value has been erased. Wealth that took years to accumulate has vanished in mere weeks, leaving investors, pension funds, and everyday Americans scrambling for answers. What makes this crash even more devastating is that it is not the result of a financial crisis or corporate mismanagement. It is a self-inflicted wound, caused by reckless economic policies that have shaken confidence to its core. The ripple effects of this collapse are spreading far beyond Wall Street. Retirement accounts have been slashed, investment portfolios are bleeding, and millions of Americans are watching their savings shrink. Even those who do not own stocks are feeling the pressure, as the sudden loss of wealth is triggering a slowdown across multiple sectors of the economy. Consumer spending, one of the biggest drivers of US economic growth, is beginning to falter as people become wary of big purchases and financial risks. The destruction of wealth is not limited to stock market traders or high-level investors. Pension funds that millions of retirees depend on are seeing sharp declines in value. States like California and Texas, which manage massive public pension programs, are now staring at budget shortfalls as investment returns plummet. If the market continues its downward spiral, retirees could face benefit cuts or higher taxes to keep the system afloat. This collapse has also sent shockwaves through the corporate world, where businesses rely on strong stock performance to raise capital, expand operations, and fund innovation. When stock prices fall, companies lose their ability to borrow at low interest rates. Many corporations that plan to issue new stock offerings have put those plans on hold, afraid that weak demand could further depress their valuations. This is more than just a temporary setback. The U.S. is watching its wealth evaporate at an unprecedented pace, and without a major shift in economic policy, the consequences could be long-term and devastating. If the bleeding continues, America may soon be looking at something far worse than a market downturn. It could be staring at the beginnings of a new economic crisis. Right now, the U.S. is at the edge of that cliff. One of the most troubling indicators is the slowdown in hiring. While unemployment remains relatively low at 4.1%, the job market has begun to cool in alarming ways. Employers are freezing hiring plans, and some are already cutting jobs in sectors that rely on global trade. Major industries, such as manufacturing, transportation, and retail, are bracing for an economic slowdown as tariffs drive up costs and shrink profit margins. Consumer confidence is another casualty. The American economy is driven by spending. If people stop buying, businesses stop earning, and layoffs begin. In the wake of the tariff chaos, consumer sentiment has fallen to its lowest level in nearly 3 years. Delta Airlines recently warned that a decline in travel demand is directly tied to fears of an economic downturn. This is a warning sign that Americans are beginning to tighten their wallets, a precursor to reduced spending across all sectors. But the threat is not over. The biggest wildcard in this crisis is China. For decades, China has been the largest buyer of U.S. debt, holding over $800 billion in U.S. Treasury bonds. These bonds are one of the key reasons why the U.S. can borrow money cheaply and finance its enormous deficit. But what happens if China decides to sell off its holdings? The mere hint of such a move could send interest rates soaring, crushing the U.S. housing market, making loans more expensive, and increasing the cost of America's debt payments. China doesn't even need to completely dump its holdings. It only has to threaten it to rattle global financial markets and further weaken the U.S. economy. While China is America's biggest threat in this trade war, Canada is no small player either. Despite its reputation for diplomacy, Canada has already signaled that it is prepared to retaliate aggressively. Canada has warned that its government will respond dollar for dollar if the U.S. does not roll back its steel and aluminum tariffs. That means higher tariffs on American goods entering Canada, which could be catastrophic for U.S. farmers and small businesses that rely on exports to the Canadian market. So, in a nutshell, the U.S. is in huge trouble, and all this happened in just 20 days. Do you think there is a way to save the U.S.? Can anything still be done? Let us know in the comments section. Has Trump messed up? Do you want to watch more videos like this one? If yes, subscribe to our channel and press the bell icon next to it. We have decided to bring videos on something nobody talks about: African politics, economy, and increasing power. Thanks for watching, and until the next video, stay tuned.
Tell us what you think in the comment section. Like and share the video, and subscribe so that you don't miss any of our African videos. It's the best way to support us.